Hi, everyone. I'm Josh Curtis, founder and CEO of EQB. We are a tax mitigation firm that specializes in helping folks mitigate taxes in a few areas. So, for example, streamlining and saving cost in qualified plans, helping folks that are starting or own businesses to eliminate a lot of garbage taxes like self-employment taxes and a lot of little known legal tax strategies. For example, renting your house to your company to get a deduction for your business and tax-free income to you personally. Another piece is we help folks with deferring large capital gains tax when selling a highly appreciated asset like a business, real estate, high value art and collectible, even cryptocurrency. So that's what we're going to talk about today in the form of a bespoke strategy called the Deferred Sales Trust. And with that, I'd like to introduce Greg Reese of Reef Point LLC. Greg and his team are the #1 trustee in the nation with this tool. And Greg has 30 years of deep expertise in real estate, securities, finance, taxation, estate planning, and of course, the top trustee in the nation for the Deferred Sales Trust. So, Greg, it's good to chat today. Thanks for joining.
Thanks for having me, Josh. It's a pleasure, and it's great to see you again.
Yeah, you too. So, I think we'll start out with just a very basic question. What is a Deferred Sales Trust?
Okay, so we'll just get kind of mechanical a little bit. So, The Deferred Sales Trust is effectively a specialized form of installment sale governed under IRS Code Section 453, and installment sales are specifically provided for under that section, and they're a great way to help people defer capital gains taxes. It's a strategy that's not new, but it is still new to a lot of people. It actually has a 25-year track record, legal, proven, and IRS tested. And that's the high level of what this is.
Okay, interesting. So it's been around for a while. And I think I was reading before this that the actual statute upon which it's built, you mentioned the installment sales, something like almost a century old, right? So
yeah, been around about 90 years.
Amazing. Yeah.
Twice as long as 1031 exchanges by comparison.
Yeah, which it seems like they've done a pretty good job of marketing, right? So
absolutely.
So that's tactic, like you said, mechanically, what is a deferred sales trust? Is that specialized form of installment sale? But who really benefits from using one of these? I referenced it earlier, but to get a bit more deep understanding, who really benefits by using this tool?
Yeah, well, I'll just piggyback on what you said in the intro, Josh. And it's really anybody who's looking to sell a highly appreciated asset and is interested in deferring the gains from the sale of that asset. This could mean selling a business, selling highly appreciated real estate, whether it's held for investment purpose, and it can be even used in certain circumstances when selling a highly appreciated personal residence. Could be raw land. It could even be when you're selling an interest in a multi-owned enterprise, like a partnership or a corporation or something of that nature, where maybe you're a major shareholder, and when you're selling your business or what have you, or the real estate, that maybe your share is going to be highly taxed, where minority shareholders might not be. It's still a strategy that you can take advantage of.
Interesting. So, and I know we'll get into this a bit later, but something you mentioned is, fairly crucial, I think, is the ability to almost separate partnerships, it sounds like, or if there is a partnership, or separate interests, rather. So that's interesting. The challenge, I would think, in thinking through that is, it's a bespoke strategy, so it's not for everyone. I think that's the definition of the term. What's the bar? I guess what's the amount of gain? What's the amount of sale? Like, when does an end user see some sort of benefit from the use of this tool?
Sure, good question. So, interestingly, it's not based on the market value of what you happen to be selling. It's really based on the degree to which we can help you defer taxes, which we'll get into what are the benefits in a little bit, I'm sure. But the rule of thumb here really is that if the asset that you're selling has appreciated at least $250,000, meaning that that's going to be the taxable amount that you're staring at, that makes the DST a viable strategy for you, and you definitely should consider it and learn more about it. Another way to say the same thing is if you have recognized, or your CPA or accountant has let you know that if you sell this asset without any particular planning, it's going to cost you $80,000 to $100,000 or more in taxes, then the DST is something you definitely should be looking at and consider.
Interesting. Yeah. Well, 250,000 of taxable gain, you say, not taxes, but taxable gain. That's a lot lower than I think most people would probably expect from something like this. So,
I mean, kind of interestingly, I mean, we have transactions in the low hundreds of thousands of dollars to the multi-millions of dollars, right?
sure.
You could have a small business owner who owns a, mechanic shop or towing service or some franchise or something like that. Maybe they're only selling for $300,000. When you net out the brokerage commissions and the fees, it's all taxable because they have probably no basis in it. So their taxable amount, what they end up with is at least $250,000. That could be all taxable. That, having to dilute your nest egg to pay taxes, that can affect your future income or growth plans.
Oh yeah. I mean, we could probably math will always win in pre-tax investing over post-tax, no doubt, over the long term. I think the challenge that a lot of folks would probably have with this is, okay, I get that, but it sounds too good to be true, right? I can sell my business and not pay taxes. I get that investing that big chunk of money could certainly, compounding returns build a lot more, but what's the catch? Is it legal? Has it been tested? I mean, I've heard all of these questions. What's the catch?
There's not really a catch. The only real challenge, and I guess if you're going to come up with the downside is the fact that it's still new to a lot of people. And, the reason why there hasn't been dozens or hundreds of other tax attorneys or firms that are trying to replicate what we do or approximate it is because they haven't undergone the necessary scrutiny over the years to demonstrate to their clients that in fact this is legal, proven, and tested. So you've kind of asked, about what does that mean, right? So whenever you're engaged in any kind of a tax strategy that seeks to mitigate taxes in some respect, in our case helping to defer taxes, well, it takes a while for the IRS to even take notice. They may audit some of your clients, they may come directly to you and want to know exactly what you do, and kind of in a formal review or an audit kind of scenario. You may want independent parties taking a look at this to see if they can crack any holes in it, to see if they feel confident in its ability to achieve its objective. And so what's happened with the Deferred Sales Trust, acronym DST, and I'll just throw in for a second that the Deferred Sales Trust, acronym DST, is the same acronym associated with Delaware Statutory Trust, right? So people get confused. They're not the same thing. Sometimes there's some interplay between the two, but Delaware is really a passive investment in real estate that is eligible for a 1031 exchange, where a Deferred Sales Trust is really a vehicle and a strategy that allows the seller to sell that appreciated asset or assets, defer recognition of the gain, reallocate their sales proceeds into virtually any investment asset classes that they wish, and to generate income or growth or a combination of both at their design, what they're looking to accomplish. And so it makes it really flexible and nice for a lot of people, especially if they're looking to get into an exit strategy, because we talked about what's it used for. Exit strategies where I want to sell and I don't necessarily want to reinvest back into the same asset class, could be used as a 1031 exchange alternative, meaning that in the event I'm selling real estate and I want to reinvest back in real estate, we know that the rules set under 1031 exchanges are very narrow. Time limits and all kinds of boxes you have to check, and 45-day windows and 180-day windows, and up in purchase price, up in basis. Well, the DST could be used as an alternative vehicle to a 1031, where you might want to have the opportunity to park your money and wait for the right opportunity, not just what shows up in the next 45 days. The third sort of lane that the DST travels in is rescuing failing 1031 exchanges. So for those people that are already testing the waters, going down that path, if they can't find suitable replacement property in time, or the deal that they're trying to negotiate on blows up, before the time limit, then our DST can serve to rescue them and continue to defer those taxes. And so, challenges are that because it's still new, well, before I say that, only the estate planning team and our tax law firm that created this in the first place has gone through the requisite testing and scrutiny over 25 years. So we have done over 3,000 transactions. We have closed more than $100 billion in total transactions in that time. We've had a handful of audits, 15, 16 audits during that period of time. Every single one of them resulted in a no change letter, which is your gold standard. Perfect outcome. We've had the IRS actually do 4 different independent reviews with us directly to really understand exactly all the techniques that we use, the document sets, when we engage in transactions, everything about it. And they have concluded that every single time it's legal, it's complicated, but it is legal. And then we've had independent top-ranked tax law firms around the country, and even quasi-government agencies, aside from the IRS, take a look as well. We have never had an adverse finding in all of that time. It takes time to get to that place, right? So that's the primary reason why it's still new to a lot of people, because there aren't other tax law firms that are trying to do what we do. And even if they tried to pick up the mantle and figure it out today, it's going to take them years to undergo the same level of scrutiny that's involved. So sometimes it's a challenge talking to a client's CPA, for example, or their personal attorney, because they may not have heard of the term deferred sales trust, which is merely a trademark for the technique and the strategy as a whole. But once they understand the code section that it's based on, once they understand the mechanics of what happens, then the light bulb goes on to say, oh, I get it now. And so that's probably our biggest challenge, if you will. But as far as downsides, or is it too good to be true? No, it's not too good to be true. This is actually the real deal. And we've got a 25-year track record to demonstrate that. So
that's huge. So it's not like this is some exotic strategy that, the IRS has never looked at. It's based on a 90, almost century old statute. It's built upon that. It's been around for 25 years. You guys have had, you said 15 audits and 4 independent reviews, 19 interactions with the IRS, arguably one of the most feared, agencies, if not in the US, right?
Definitely.
And every single time they said, no big deal. I mean, yeah, it's complicated, but it's real. I mean,
Exactly.
that's significant. So, we could just stop there. So let's get into the mechanics. So we talked about, high level. Tell me a little bit more about the mechanics of a typical transaction.
Okay. No, good question, because there could be some myths and stuff around this that I haven't talked about, but maybe this will help. So, for example, the typical mechanics of this is that you're looking to sell your business, your real estate, your collectible, what have you. If let's just take businesses and real estate, which are probably the 2 most common types of transactions that we work in. Well, you're going to undertake the same process that anybody would in your shoes. You're probably going to hire a professional to represent you, to list the property or the asset, to start attracting buyers, entertain those offers, and you are going to negotiate the terms of your sale with the ultimate buyer. Okay, So you're in control of that process. What we're going to do is come in and embed with you sort of during that due diligence period, or usually we'd like to start around the time you're putting it on the market or you're starting to entertain offers. That would be sort of the ideal time for us to sort of integrate with you. But we're going to do some work in the background. We're going to work to create a trust as the central structure. Our tax attorneys are going to work with your closing agents, which could be a closing attorney, it could be escrow, it could be title, you know, the middleman of the transaction between the buyer and seller to make sure all the, you know, due diligence and stuff, compliance is checked off. And
Right.
so at the close of the transaction, you'll make kind of your final decision in election. So it's important to note that people often think, well, does that mean I have to transfer my business or my property to the trust? And then you guys put it on the market, and then what happens? And what if I decide I really didn't want to sell in the first place? Sounds like it could get complicated. No, not at all. Because you're not going to make your final decision until right before the transaction is supposed to close. At that point, in the affirmative, the asset will transfer from you, the seller, to the ultimate buyer for the exact agreed upon terms that have been negotiated right there. The trust will receive the proceeds of sale from the buyer, and you will receive a promissory note for the exact amount with a security agreement that protects all of those funds. And we'll talk some more as we go on about protections and so forth. But that what that does, it allows you to avoid constructive receipt of the sales proceeds. And by avoiding constructive receipt of the proceeds, it allows you to defer the taxes. You don't have to, you don't have to pay taxes at that time. And then you'll only ever pay taxes when you actually start to receive distributions from the trust. Okay. So myth number one, I got to part with my asset first and then hope for the best. No, because you could pull out at any time before the close and you would not be responsible for any fees because all the work we do is on a contingent basis to begin with. And so you pretty much at that point, all the contingencies are removed, you're moving forward. The only question is, do I want to pay my taxes? Do I want to maybe test the waters temporarily with the 1031 exchange and then leave us kind of as your backup plan? Or do I want to move forward with the deferred sales trust? Those are your options, and it all happens at the end. So you've got a lot of time to really contemplate, what's right for you and what's in your best interest. So that's pretty important. I would say that, and then, sort of a common typical transaction, because we deal with a lot of business sales, and we do deal with a lot of real estate partnerships, people that own, property together in their family, or they have partners, or they have other shareholders, for example. So, mechanically, the same thing is going to occur, whether you're selling a business. We can deal with any type of business ownership structure, C Corps, S Corps, sole proprietorship, held in a living trust, tenants in common, you name it. And to the extent that there are individual members of an ownership group that want to avail themselves of the DST, they can, even if others don't want to. So unlike like a 1031 exchange in a multi-owner group, for example, oftentimes they all have to march in the same direction together. It's all or nothing. They all have to go this direction or nobody gets to go that direction. So this allows you to kind of break up your own interest, and moving forward, you're not tied to the hip with any of your former partners. You get to determine your own destiny and all the decision making around it that goes on. So it's pretty attractive from that standpoint. But if that makes sense, just as a recap, you'll negotiate the terms of your sale. You'll decide at the close whether you use the structure we've created for you. The trust will receive the funds. You will receive a promissory note for the exact amount coming out of the transaction, and you will also have a security agreement on the funds, which gives you, a lot of rights, creditor rights, and others that we'll talk more about. And then you report the sale as an installment sale under Section 453. And to the extent that you don't receive any of the proceeds in that year, you wouldn't pay any taxes. To the extent you do receive some money, whether it's walking around money at the close or a series of monthly, payments that you want to receive, you'll only report and pay taxes on what you actually receive from the trust year to year. So it's kind of that simple.
That's interesting. So I had a couple more questions along those lines, but you answered them. So what happens with the cash from the buyer? It goes from buyer to trust, and then once the asset's sold, what sort of control? So there's the trust, but the seller or taxpayer has that promissory note and the security promise too. So that's significant. So what if you'd mentioned, what if folks want to not take any income? What if the opposite happens? What if they need more? What if, that promissory notes, call it 50 grand, 100 grand, a million, 2%, 4%, 8%, whatever it is. What if they need more? What happens then?
So that's a good question. So, under the installment rules, there's always going to be a contractual obligation in place between the trust and the seller. And that contractual obligation is known as a promissory note or secured installment note, which means that as the trustee, I'm working with the seller to determine what they want out of this. So for example, are they looking to generate a specific amount of income? Are they looking for growth? Are they looking for a combination of the two? They'll create a note, but to the extent that they need money at the close, they can have whatever they want. They just pay taxes on what they receive, right? It's just sort of the normal situation. To the extent that we're structuring a note, which provides for payments on an installment basis, a periodic set of payments that go to the seller, to the extent that they want to change that, circumstances in their lives change. I actually need more income from this than I've been receiving because my lifestyle is changing, or there are, other emergencies or things in my life. I can go back to the trustee and we can increase the amount of income that's distributed to the client. To the extent that you're receiving more income than you really need, we can back down the payments for you. To the extent that you don't need income for a while, common example is if you're selling a business, it's not uncommon for the seller to stay on as a consultant for a period of time to help the new buyer fully understand how your business works and how to make sure it remains profitable. So they may be getting paid for 1, 2, 3 years, who knows? During that period of time, they may not need any extra income coming from the trust. Maybe they prefer to let it keep growing, and then they'll start a payment stream, in 1, 2, or 3 years down the road, which makes it nice. So the notes can be modified. The general rule is that it should be relatively infrequently, not treated like it's a personal ATM card or a piggy bank, but always have access to your money, lump sum or changes in the income stream, especially during any kind of family emergency. But beyond that, every year or two, something of that nature, plus emergency reasons, you could ask for the note to be modified to change the terms or the amount. So very flexible. It can also be that the terms of the note can be accelerated or extended, meaning that you could have a note term of say 10 years. You may want to, decide that you want to withdraw all the money and pay the taxes in 5. Can you withdraw the money? Yes. Is there a penalty or a specific charge for doing it early? No. I like to say there's no penalty for early withdrawal. It's not a CD, right? Likewise, if you like what tax deferral is doing for you and you want to extend it for additional periods, you can. And there's no limit to how many times you can extend the note. It could last virtually through your family's generations if you wanted it to.
Wow. Yeah. So ultimately, a lot of flexibility. You can defer some payments that you might normally get. You can withdraw money really at any time. Of course, you have to pay the tax to dip into the principal, but it's flexible. It's possible. There's control there. So I think when I think about, really what's the fundamental benefit, and you can add on to this if you want to, it's getting all of that money compounding over time, creating that income stream, and modifying it over time as well, instead of, taking a 20, 30, 40, 50% cut, whatever that is, at the time of sale of some highly appreciated asset, whatever that is. That's helpful. So, we talked about minimum viable, kind of the size of that 250 taxable gain. I know we've touched on fees, but that's always probably a big question. what's the catch? Well, there's not really a catch. There's the downside we talked about earlier, but of course, there's people have to get paid to set this up. So talk a little bit about the costs.
Okay. Sure. It might be helpful to just talk about some additional benefits before the cost to sort of put it in perspective. So really, I'd offer two things, Josh. The first is, what's the benefit of being able to defer taxes in the first place? So there's really three fundamental benefits to the ability to defer taxes on your sale. Number one, you get to defer the taxes you otherwise would have paid in the year of sale. What does that mean? You get to use the money you would have paid in taxes to generate higher amounts of income or to grow your wealth more rapidly, or a combination of both, by reason of not having to dilute your investment nest egg with the tax burden all at once in the year of sale. So that's huge. So quick example, what if you were just selling an asset for $1 million? Let's say it was all taxable. And let's just say that your tax amount would be $300,000. What if you got to keep that $300,000 working directly for your benefit? What could you do with that? What could you generate from an income standpoint or from a growth standpoint? That's number one. Yeah. Number two, from the tax side, is that you can engineer when you pay taxes, how you pay taxes, and what tax brackets you pay in by having control of the lever of the payment stream, working with your trustee. So if you want to, if you take all of your money in the year of sale, you're almost every client of ours would be, because of the minimum, viable nature of it, would be at the top tax brackets in every state, federal level, Obamacare tax, the whole 9 yards. But what if I didn't need to take that $1 million right now? What if I didn't need to consume it? What if I only needed $200,000 a year? I can effectively lower my tax brackets when I do pay taxes by 10 to 15%. So lowering the tax brackets is the second benefit. And third, as a tax deferral strategy, you're not escaping taxation. You're not avoiding taxation. You're deferring it. But what it does is it allows you to pay today's taxes with tomorrow's dollars. You may not pay your capital gains for 5, 10, 20, 30, 40 years down the road. I always am asked, well, what's the best time to pay my capital gains? And my typical answer is second day after never works for me.
Right?
Yeah. Can you do that? Pretty much, never's a mighty long time, but pretty much you can do that. There's no statutory limit, on pressing it down. So that's really the tax advantages. But then let me offer your listeners a quick analogy. So imagine that you could sell your appreciated asset and the proceeds of sale go into this trust that acts in 5 specific ways as though it's your personal 401k plan. And I use this analogy because the DST is new to a lot of people, but they understand 401k plans. So there's some really close comparisons here. So the first one is, when the trust has the proceeds, what happens to the money? Well, typically the money needs to be invested to deliver on what your goals are, what you want out of it. You, the seller, have to either direct or approve how the trust reinvests the money. Nobody else takes that control away from you. We work together to make sure that you have a lot of information and data and facts on what options are available to you. But at the end of the day, you direct and or approve all investment the trust ever makes, number one. Number two, you also control how much you want to be receiving from the trust month to month, year to year, what have you. Much like a 401k plan. If it's your 401k plan, you're going to decide how much you need coming out of that plan. If I don't need any money out of it now, I don't withdraw it, I don't pay taxes, it keeps working for me. If I need a specified amount of money, that's what I take. If I need to change it next year, I can change it next year. The point being, and this part of the analogy is, most people that have 401k plans, they withdraw what they need and they only pay taxes on what they withdraw. If I needed $50,000 a year to supplement my income out of my 401k plan, am I going to draw $200,000 this year? No. It would be kind of foolish. That would not be economical at all. Right. Because now I'm paying tax on money that I don't need to consume. better off they're left in the account to keep growing and earning for me, right? So that's the second comparison. The third comparison is really part of what I just said. You only ever pay taxes on what you actually receive from the trust from year to year. It's that simple, just like that 401k analogy. Number four is really sort of legacy and estate planning benefits. So what happens to my DST if I should die or something happens to me? Well, there again, you'll control the ultimate distribution of the DST funds to your designated heirs. So think of it this way. You have a DST note, right? Which is an obligation to pay you all your principal plus an attractive rate of return over some period of time that you specify in actual payment amounts that you also specify. So that's an asset of yours. You can leave that asset to anybody you like. So typically, you're going to leave it to your family, right? You can leave it to charity or anybody you want. That's yours. Finally, final comparison is asset protection. Asset protection comes as a byproduct to what we do, but very much like a 401k plan, which, as you know, because this is your space, this is your world, 401k plans are protected from your future judgment creditors under the ERISA laws, right? You get sued down the road, somebody gets a judgment against you, they're coming after you. They can't go after your 401k plan. It's buttoned up, it's tied up. The DST operates very much the same way. You end up with that judgment down the road, they're coming after you, they cannot get at the principal of your DST. Comes as a byproduct, okay? So I thought that would be a helpful kind of segue or comparison to some of the benefits for better understanding. And then you asked about was it the fee structure?
Yeah, and all of that's incredible background. So that's good. But yeah, next I think fee structure, costs, and what's involved with getting this to the point where folks can actually implement.
Got it. Okay, so with every deferred sales trust engagement that we enter into, as I said before, we always do it on a conditional engagement basis. So there's no upfront cost, and the fee only applies if you actually use the DST and the DST receives the proceeds of your sale. And if it doesn't, then we just fold up our briefcase and we move to help the next customer, and there's no fee coming your way from us at all. So, but should you engage with us all the way through, there are three professionals that come together to serve as your fiduciary advisory team with your specific DST. One is going to be one of our tax attorneys. They're going to create the structure. It's kind of like setting the table before the event, right? Thanksgiving comes to mind. Do you set the table 2 days before the guests arrive, or do you wait till the doorbell rings on Thursday? Most people say, no, it's all good to go beforehand. So the attorney's job is really to set the table, right? Get everything in place. Once the transaction closes, the legal fee paid at the close as an expense of the sale is a one-time fee, and it's based on the sales price of your asset. Usually it's 1.5% of the first $1 million and 1.25% of anything above $1 million. So that's a one-time fee paid at the close, does not recur. Part of the standard engagement also includes audit defense protection. We talked about, hey, this is legal, proven, and tested. Do you put your money where your mouth is? Do you back it up? Well, we do back it up. Our attorneys put right into the engagement agreement that in the event your DST is ever audited, they will offer to step up and represent you at no additional cost. And they've never lost. And they want to do it because they have skin in the game. We have a perfect 25-year track record. They like to keep it that way. So they would love to, be the ones that represent you if it ever happens. But, the odds of that happening are pretty low. And the reason for that is the IRS has got so much information about us now, and they've passed it every time that they don't really bother. It's just a rare event that a DST is even audited anymore. Next, we've got the independent trustee. And so there's a requirement in the strategy that you have to have an independent trustee from you, because the trust by design is created independent from the seller. It's a separate entity, not directly related to the seller, that enters into an arrangement with the seller to buy their asset ahead of the ultimate buyer, so that it can be like a, what they might call a Texas two-step. The trust buys the asset, resells it to the buyer, all in the same transaction environment. And so the trust by design has to be independent, therefore the trustee does as well. And they have to have been trained and vetted and approved, et cetera, because there's some specific rule sets we have to follow, and there's oversight and compliance that we have to adhere to as well, much like a financial advisor, has to adhere to, oversight, transparency, and that kind of stuff. And then there's also a licensed investment advisor, has to go through similar scrutiny to be approved, but they're independent, proven track records, the whole 9 yards. So we talked about the legal fee at the close, which is a one-time fee. And then it's easier to just talk about on an ongoing basis, depending on the size of or the amount that's in your DST, because our fees go down by percentage as the value of the DST goes up. So worst case scenario is our fees are typically 1.1 to 1.5% annually, all in. That's the trustee and the advisor together, not separately, with the expectation that the performance of the investments that the client either directs the trust to make or approves the trust to make. And of course, we're providing some fiduciary guidance and support and help so that they can make good decisions regarding that. We expect that the performance to deliver the target rate of return on average the client is seeking net of our fees. So for example, if your target, when we go through that discussion process is 6%, 7%, 8%, whatever it may be, our target is to deliver that net rate of return to you on average during the course of your term, given all the other factors, how much you want to withdraw, how risk averse or risk tolerant you are, et cetera, et cetera. And so that's sort of the fee schedule. It's very transparent. It's the same for everybody. And, and it's very simplified. The only other expense really associated is once a year, I have to coordinate the filing of a tax return for the trust and issue, the 1099s to the client so they know how much to report on their own taxes, if any. And that's a one-time fee each year. And that's it. It's super simple.
That is simple. So you'd mentioned three parties: attorney, trustee, advisor. You are an independent trustee.
Right.
And so watching over the trust in tandem with the other parties, advisor and client, what sort of so in a way it's effectively your and client's partnership here that's managing this money. So what sort of protections, assurances and things like that, from your standpoint? I mean, I know you and I know your track record, but for new clients that are just now getting into this world, share a little bit about that and I guess the organization.
Yeah, that's probably the number one question, because when I first meet a new client, we don't know each other yet, right?
Right.
So they're entrusting me with their money. How do they know it's not going to end up somewhere where they can't get at it? Well, that's a fundamental question, because it takes time to build a relationship, and nothing like handing over $1 million to somebody you just met, right? So we do add some very serious protections in for every single client. Number one, yes, I am an independent trustee. However, I am part of the estate planning team network, which means that I agree to transparency, compliance, reporting, oversight. There are people looking over my shoulder, and they have access to all the reports and all of the financial statements and everything for every single DST. And we have an advisory and a compliance team on that side that looks at every single one of those. And of course, they're the ones that vet and train me, right? And they wouldn't accept me into this position without going through scrutiny, number one. Number two, unlike a typical trust where the trustee has sole authority over what goes on in the trust, our scenario is that there's always a two-signature rule as it relates to the client's money. On my signature alone, I can't do anything with your money. I can't even send it to you. I can't send it to like the wirehouse, like TD Ameritrade or Charles Schwab, where the investment advisor may be managing and operating. So there's always a written verification that has to occur. So, and there's typically only two ways that money is moved, after the close. So at the close, we'll set up an account at a bank typically, or at the brokerage firm custodian like TD Ameritrade in the name of the trust. So it'll come in initially. Before any money can be moved, there has to be a funds authorization signed and approved by the client that details exactly how much, where it's going, et cetera. And then as trustee, I countersign it. And then I submit that to the financial institution, who acts much like an escrow agent. You know how escrow works. They don't make a move unless they get signed in joint instructions by the buyer and seller. Same process here. The financial institution doesn't make a move unless we have joint signed authorizations on what to do with the money. So what's the most common things that are done? Number one, the client and I set up the terms of the note, the distributions they want. Let's say they want monthly payments of X. We say, okay, let me send you this authorization form. You fill in your bank and routing information where you'd like those funds deposited. Make sure we put the amount on there. You sign it, send it back to me. I'll review it. I'll sign it. We'll send it to the financial institution. They'll execute that. Number two, maybe we're moving towards agreement on how you want the trust to invest the funds. Before the advisor has any authority to invest any of the funds, he's got to have another signed authorization from you, countersigned by me. And the reason why this is important is because people would be nervous that can Greg, on Greg's signature alone, use any of your money to build a new wing on his private mansion in the island somewhere? The answer to that is no. The answer to that is no. So there's a lot of protections built into the system, just for that reason. So that's important for people to understand.
No, that's helpful. I think you're right. Those are things that just solidify the trust between the trustee, who someone has to trust, and the client. So no, that's really helpful. Well, I think,
and there are references that can be provided as well.
Sure.
That's a key component for a lot of folks. They just want to talk to people that have had a DST for a while. They want to know what their experience and relationship is with me as their trustee. They want to know, did it perform? Did the investments work the way you wanted? Are you getting the distributions you need? Is Greg as trustee responsive? Does he take care of business for you? Because, I have to tell people, which is the last thing you want to tell people, is like, I can be fired.
Sure.
I can be fired.
Absolutely.
But I could also walk off the curb, look and left, and get hit by the Prius coming from the right. So what happens if something happens to me? Well, I do have some succession planning, because Reef Point is not just me. I've got 34 people over my left shoulder that work for me in my companies. But in the event that I'm no longer serving directly as your trustee, then it's a simple matter to go back to the estate planning team or the tax attorney who represented you in the first place and say, hey, I want to fire Greg because he's just not doing his job, or Greg no longer is around, passed away or something. Right. So what do we do? Well, they introduce you to a couple of the other approved trustees. There's about 13 of us nationwide that actually have been scrutinized and certified to fill this role. So they would introduce you to other trustees, and they would just facilitate a very simple transfer of the trusteeship of the trust to another qualified trustee. Much like if you had a family living trust and you died, there's a successor built into your documents. So we have contingency plans for everything, protection wise, what happens to Greg? Can Greg be fired? So, it's good for people to know, I guess, because it just reminds me and reminds them that I have to earn my way all the way through. It's not just doing a transaction. We're going to have, a bit of an ongoing relationship. Furthermore, clients always get full transparency, meaning that we provide them with online or paper statements of all their investments. So if it's at TD Ameritrade as the custodian, a lot of protections are involved there, or Charles Schwab or Bank of New York or Fidelity, whatever the wirehouse is, there's really no limitation on which custodians can operate here. All of them do. And so they'll always have access to see exactly what's going on at all times. That's another protection that I think is important, for transparency purposes. So there you have it.
No, that's helpful. That's really helpful. So we've covered a ton. What is it? what's it based on? Centuries old statute it's built upon. What you guys have gone through, almost 20 interactions with the IRS, and they've said we're just going to stop at this point because every time there's no adverse action. The costs, your role. So at this point, I guess to wrap up, how does someone get started? How do they get information? How do they start thinking about this from a strategic standpoint?
Well, you and I work together in this space, and so we have a history now, because you have helped some of your clients, find a way to get out from under that capital gains burden, and they're super thrilled. So I would just suggest to everybody that's listening to reach out to Josh first, because Josh will kind of, get a sense of what you're looking to accomplish, give you some information and details on whether this is viable for you or not. And then typically what will happen is, Josh will coordinate a call so that we can all get on that, because as your trustee, I ultimately do a lot of the analysis to make sure that it's beneficial for you, that it makes sense. And then from that point forward, if we're moving forward in the little steps that accrue along the way, I help coordinate all those steps, the interactions with our tax attorneys to introduce them to you, gathering documents and information that we need to review about your transaction, giving you language to add into your agreement so that it sets the table, so to speak, and prepares the way to give you the right to do planning around your sales proceeds, et cetera. So I think as Josh mentioned to me before we started, that there's going to be a bookend on this video. At the end, you'll get some contact information that you can reach out, call, email, whatever you like. But Josh, why don't you just throw out your email address verbally right now and your phone number? That's the best way to get started.
Yeah, you just don't want everyone calling you with all the questions while you're soaking up California sun, huh?
Well,
I'm just kidding.
My days are pretty scheduled, and I have to make sure that I have time for my existing clients, but I always have time for new clients. And, we have regular interactions, which is why I have just a tremendous staff behind me, because a lot of the administrative stuff, they get immediate access, immediate information. And when you need strategy, when you need explanations, stuff like that, I'm your guy.
I'm kidding. I get emails from you at like 11:30 p.m. I'm like, Greg, when do you sleep, man? It's all good. No, this is good. No, my phone, 804-220-0838, 804-220-0838. And it's Joshua, Joshua, at EQBstrategy.com, Echo Quebec Bravo Strategy.com. So that'd be the best way. And I really enjoy this. I appreciate you fielding all my questions, Greg, and it's great context. I mean, this is a little known tool that more people need to know about. Whether it fits, it's not for everyone, but where it fits quite well, and it has high impact to a lot of folks' lives and financial pictures. So I appreciate you sharing all this info for us.
You're very welcome. And just kind of in closing, when it comes to dealing with mitigating, capital gains and related, the IRS provides very few legal strategies for us to engage in. And people know about 1031 exchange. People know about charitable trust planning to a degree. Opportunity zones are a relatively new kid on the block.
Right.
There's not much really to choose from, and the market has been starving for an alternative strategy that provides sort of some of the best of some of the other strategies, but more flexibility. And that's really, I think, where the DST comes into play. But for me, when I do consultations, I'm well versed in all of those strategies I mentioned. So, it's never really trying to force the square peg into the round hole, just because like it's a one-trick pony. It's about understanding what the client's needs are, what they hope to accomplish by reason of selling, and to the extent that there are other strategies that might be worth their consideration, I'm kind of going to be the first guy that's going to bring those up. I want them to fully understand what the alternatives are, because number one, if you do a DST and I'm your trustee, I'm going to be engaged with you for several years to come, probably. I don't want you to come back to me 6 months from now and say, well, wait a minute, I just learned about this charitable trust thing, and I think that would have been better for me. And why didn't you tell me about that? I
Right.
never want that question. I want you to,
Right.
if it's appropriate, I will be the first one to tell you about it. And I will explain how
Exactly.
both works and the pros and cons. So just know that I'm a fiduciary. So
Yep.
a fiduciary is a person in a position of trust that has to act in the best interest of the client, not his own,
Got it.
not some third party. And to the extent that you do not do that, there are legal consequences. And I don't have any legal consequences. So, because I do my job the right way. So I appreciate you having me, Josh. It's been a pleasure. Always love our interactions. Anything else that you want to know at this point, or?
No, I think that's everything. Like I said, we've covered so much, but I appreciate the time and looking forward to, many more interactions down the road.
All right.
It's been fun.
All right. Well, thank you so much. Take care.
See ya.